How to get started with stock market investing. I was speaking with Sean Tepper, founder of Stock Screening App TYKR, the other day. We were discussing the financial education of some of his students, and he said that one of the most frequent questions that he gets asked is, how can I get started with investing? Now, this is a big question and probably warrants several hours of tuition, if not more. But here are some concise thoughts to get you started. Starting to invest in the stock market can seem intimidating, but it can also be a great way to build long-term wealth and financial security. So here are a few steps you can follow to get started. First, educate yourself. It is important to understand how the stock market works and to familiarize yourself with different investment strategies. There are many resources available, such as books, online courses, and seminars that can help you to learn about investing. Start by reading Warren Buffett's biography, The Snowball by Alice Schroeder, and then go online to the Berkshire Hathaway website and read Warren Buffett's shareholder letters. They're all available there for free. They are an excellent education in long-term investing. Warren Buffett says, risk comes from not knowing what you are doing. He also says the most important investment you can make is in yourself. The next step to consider is to set investment goals. Determine why you want to invest in the stock market and what you hope to achieve. Do you want to save for retirement, a down payment on a house, or something else? Knowing your goals will help you determine the best investment strategy for you and will help you determine how much risk you are prepared to take. You have to think long term. This is at the very least a 5 to 10 year strategy. The next step is to develop a plan. Once you have set your investment goals, create a plan that outlines how you will achieve them. This plan should include the types of investments you'll make, the amount of money you want to allocate to each investment, and the time frame in which you hope to reach your goals. Next, you have to develop a budget. Figure out how much money you can afford to invest on a regular basis. Keep in mind that investing involves some level of risk, so it's important not to invest money that you may need in the short term. Of course, you will have to open a brokerage account. To buy and sell stocks, you'll have to open a brokerage account so you can actually trade on the stock market. There are many online brokerages that offer a wide range of investment options and tools to help you make informed decisions. There are also several types of accounts you can use to invest in the stock market, including individual retirement accounts, IRAs, employer-sponsored retirement plans, and taxable brokerage accounts. Consider factors such as fees, minimum balance requirements, and tax implications when choosing an account. Ideally, find a brokerage that is well established and low cost. If possible, it helps if they have an app that you can use to manage your investments. Well, you've got it all set up now, so you can start investing. Once you have your brokerage account, then you can start investing in the stock market. It is important to diversify your portfolio by investing in a variety of different companies and sectors to spread your risk. Remember that investing in the stock market carries inherent risks, and it's important to be aware of these risks and to invest responsibly. It's also a good idea to seek the advice of a financial professional, and I've got more to say on this at the end of the video, before making any major investment decisions. Now, that is all the obvious guidance. So far, so good, motherhood and apple pie. Now, for a little more specific educational information, not advice, based on my experience. Firstly, invest regularly. Commit to investing a regular sum in the market. You cannot time the market. No one knows what's going to happen tomorrow. But what is important is time in the market not timing the market. This will give you the benefit of pound/dollar cost averaging. You should go and look up what that means. Now, you need to keep current with what's going on in the market, but ignore forecasters. By all means, watch the financial news, read financial papers, and learn, but ignore all forecasts, tips, and encouragements to trade. Did I already say that no one knows what's going to happen tomorrow? Forecasts, Warren Buffett said, may tell you a great deal about the forecaster. They tell you nothing about the future. Leading on from this, I would also exhort you to ignore technical analysis. Ignoring technical analysis, which I think is complete nonsense, forces you to teach yourself about how you analyze a company from a fundamental perspective. Start with learning how to understand company financial statements, the income statement, the balance sheet, and cash flow statement. If you know nothing, buy an index fund. If you're really starting from the beginning, find a low-cost index fund covering, say, the S&P 500 or some other major index, and just buy that. It will also give you the benefits of diversification as you are not just buying a single stock. Minimize taxes. You need to protect your investment from taxes if you can by investing through a tax-protected account such as an ISA in the UK. If you trade frequently and crystallize capital gains taxes, you will have to pay them, and this is taking your money out of the market. It's better to stay in for longer with the capital gains compounding on the money you would have paid out in taxes. Keep your costs low. Now, this is an essential piece of advice because keeping your costs low improves your return, and fund management and dealing costs are what can really eat into your returns. Warren Buffett says when trillions of dollars are managed by Wall Street charging high fees, it will usually be the managers who reap outsized profits, not the clients. Ignore tipsters. Do not listen to your neighbour tipping stocks he claims to have made a killing in. Ask him instead about the other 99 stocks which killed him. Make sure you invest and don't trade. Invest for the long term and do not trade in and out of stocks. You will never beat the market, however smart you think you are, and you will erode your returns with your dealing costs. The only person who will benefit from this is your broker. Now, I have a 2-year holding rule. Once you have made an informed, well-researched decision to buy a stock, be prepared to hold it for a minimum of 2 years. Only then will you begin to find out whether your investment thesis was correct. Quote, if you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Of course, Warren Buffett. He also says the best holding period is forever. And that's what he says. Our favourite holding period is forever. When it comes to compounding, I'm not going to go into this in a great deal of detail, but you need to understand the power of and importance of compounding when it comes to investments. Go and do some research. Let me introduce you now to Mr. Market. You have to understand the inconsistency of Mr. Market, up one day, down the next, and ignore him. If you find this difficult, stop looking at share prices. Be contrarian. Don't follow the herd. When markets fall, see it as an opportunity as prices are lower. When markets are high, be cautious about overpaying for stocks, however good they seem. Remember, markets are not efficient and investors are naturally irrational. Warren Buffett says, be fearful when others are greedy, be greedy when others are fearful. The circle of competence. Never buy a stock whose business you don't understand. If you really like the sector, buy a fund actively managed by professional investors who do understand it. For instance, I don't buy biotechnology stocks because I don't understand them. Quote, never invest in a business you cannot understand. Warren Buffett. Moats. You want to invest in a company that is like a castle with a moat, surrounded by a body of water, a high-quality business, which makes it very difficult for the competition to compete with it. Think Coca-Cola or McDonald's for two very obvious examples. These companies are seldom cheap, but have much better long-term prospects. It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Warren Buffett. Don't overpay. Make sure that you understand what a margin of safety is. Ask Benjamin Graham in his book The Intelligent Investor, and make sure that you don't overpay. Be patient. Most bad investment decisions are made on the base of emotion and not research. You need to learn patience and become disciplined about your investing. It is worth reading what Charlie Munger, Buffett's longtime partner, has to say about investor psychology. Warren Buffett has to say, the most important quality for an investor is temperament, not intellect. Inflation. Now, inflation is back with a vengeance, so it is now very difficult and expensive to simply keep all your money in cash. The do-nothing option has in effect gone away for a few years at least. Cash is the worst asset you can have. Warren Buffett. Today, people who hold cash equivalents feel comfortable. They shouldn't. They have opted for a terrible long-term asset, one that pays virtually nothing and is certain to depreciate in value. Let me come back to the subject of advisors, something about which I feel very strongly. Professional advice is great when it's good advice from a good advisor. Unfortunately, there are very few good advisors. Before entrusting your money to anyone, make sure that they know what they are talking about and have appropriate knowledge and experience. Qualifications keep the regulators happy, but anyone can take an exam. Warren Buffett again. Wall Street is the only place that people ride to in a Rolls-Royce to get advice from those who take the subway. And finally, let me leave you with Warren Buffett's two key rules of investing. Rule number 1 is never lose money. And rule number 2 is never to forget rule number 1.